Welcome to the Capital Link Shipping Podcast Series. I'm Nicholas Bornozis, President of Capital Link and organizer of today's podcast. Today's discussion will focus on how IMO 2020 is going to change the energy world. IMO 2020 has been the talk of town, and we are delighted to have with us leading industry experts. Namely, we have Torbjørn Kjus, Portfolio Manager in Vistin Trading, and Jim Cirenza, Managing Director from DNB Markets, Inc. Torbjørn and Jim will discuss and share with us their invaluable insight on this topic that they both know very well. And without any further delay, I will pass the floor to Jim and to Torbjørn. Jim, go ahead.
Thank you very much, and it's a pleasure to be here with Torbjørn today. We've worked together for many years, and over the last 20 years, his resume includes BP, Statoil, and last but not least, DNB. With January 2020 and the IMO changes in allowable sulfur content in shipping fuel, we're seeing a lot of changes in the market. Ship owners have ordered more than 2,000 scrubbers. Oil refiners' stocks prices have performed very well. Scrapping appears to be increasing. And star analyst Torbjørn Kjus has left DNB to start up Vistin Trading to take advantage of upcoming market opportunities. So Torbjørn, starting with the last point first, tell us about what these changes mean to you and what they mean to the market.
Yeah, thank you, Jim. Thanks for a flattering intro. So basically, I've been an oil analyst for 17 years now, and this specification change in shipping and the sulfur content allowed to burn is the largest specification change that's ever happened in the oil industry. So people probably know that there's been a gradual tightening of sulfur levels in road transportation. For example, in Europe, we're down to 10 parts per million sulfur now in road transportation in the diesel. In shipping, they can still burn 3,500 ppm sulfur in the fuel. And that's going down to 500 ppm by 1st of January 2020. And this has been a long time in the cards, of course, because shipping has been the most polluting industry when it comes to sulfur. When you look at transportation sector, shipping is only 7% of the transportation sector, but still emits 90% of the sulfur. So it's way overdue that something is done, and actually this decision was taken already in 2008. By the International Marine Organization, which is the UN body that regulates this. And there's been several occasions and possibilities along the way to postpone this to a later date than 2020. And the last chance to postpone this implementation date was in October 2016. But then all the different studies and reports had been issued, and the final date was not then postponed. It became 1st of January 2020. Now, this means that the shipping industry needs to go down from 3.5% to 0.5% sulfur. And in order for this to not be a problem for refining, we would need to see probably 30,000 scrubbers installed by the shipping industry within the next 15 months. We think that's of course not possible. So this means that it's going to have an effect on the refining industry, because we see that scrubber orders, yes, they are coming up, but we will not have enough scrubbers installed by 2020. We assume that we might be reaching somewhere between 2,000 to 3,000 scrubbers, and even if they're all potentially installed on only large ships, which doesn't seem to be the case, by the way, it would not solve the problem, of course. There's about 23,000 ships in just container lines, in dry bulk, and in oil tankers alone, which is the ships that mainly consume the 3.5% sulfur. So what this really means is a big challenge for refining. And we think that even with the scrubbers being ordered, maybe 2,000 to 3,000 scrubbers and some cheating, we will lose about 75% of the demand for high sulfur fuel oil in the market in 2020. That probably needs to find other markets. Now, other markets for high sulfur fuel oil is very limited because shipping is behind about 50% of the market for high sulfur fuel oil. The other parts where you use high sulfur fuel oil is, number one, power generation, and then mainly, of course, in the developing world. And there's some industrial production, like cement production, for example. Refineries use 300,000-400,000 barrels per day of this themselves to generate the power in the refining, to run the refinery. And there's, of course, asphalt, which is not a big market. It's about 1.7 million barrels per day globally, and it's not like the asphalt market can suddenly explode to the upside consumption-wise. So we think this has to find its way into power generation, the high sulfur fuel oil. Now, even larger challenge, or equally large challenge here, is to produce enough middle distillates, the diesel side. Now, marine gas oil is an already large product in the bunker fuel. It's a couple of million barrels per day, which is marine gas oil, which is already being used in the so-called ECA zones, the zones on the both sides of the US and in the Northwest Europe, which is already a tighter regulation where you can only emit 0.1% in sulfur in the fuel. So what's going to happen, we think, is a challenge for the refining industry to produce enough low sulfur fuel oil, middle distillates, number one, for direct consumption as marine gas oil, but number two, also for blending to create the new 0.5% fuel that's going to be used in the shipping industry. So I'm not sure. Your next question, Jim?
Yeah, let's talk about something that you brought up about a month ago, that maybe there would be enough gas oil and low sulfur fuel available. And I guess maybe means assuming we don't have a recession between now and 2020, but let's talk about the risk of a possible deficit of gas oil. Let's talk about will higher prices for gas oil drive sufficient supply in a reasonable period of time? And what will be the refineries industry's impact on the ultimate oil demand, because I assume the refineries will be working at higher capacity going forward.
Yes, I think that's also one of the reasons why refining shares have been performing as a function of IMO, because and we agree that in 2020 the global refining system will probably need to run pretty hard to create enough middle distillates. We think it's going to be a situation a bit similar to 2008. And what happened in 2008? Well, we had a diesel squeeze. In March 2008, we already had $25 per barrel margin for diesel. But diesel demand kept on increasing after March 2008, when we had $100 per barrel crude price. What that means is that when you have a $25 margin for diesel, you would see all the hydrocracking units and all the cokers in the world be running as hard as they can, because they are then the money machines in the refinery. But when they cannot run any harder and all that capacity is fully utilized, and you still need to produce more diesel, then the only way to get more diesel is to get your straight run diesel, which is directly from the distillate tower in the refinery, which means you just need to run more crude oil. And that happened in 2008, and from March to July in 2008, you saw refinery runs being pushed higher, despite global oil demand kept on falling through the whole year, but diesel demand did not fall. It kept on rising because there was Olympics in China, and they need to fill up their diesel inventories, and they also had a big earthquake in China that took down the grid, so they need to fire up their diesel generators. So basically in that period, the Brent price went from $100 to $147 per barrel because of this gearing effect. Because when you have no more spare capacity on the upgrading units, the coking and crackers in the refining system, you have to run more crude. And then you need 3 barrels of crude to get that 1 incremental barrel of diesel. And that's how you get to $250 per barrel almost in 2008. And we think a similar situation could arise in 2020. It will be enough diesel, but it will be required to run the refining system harder. So basically, we think even simple refineries will need to run pretty hard because total utilization rates will need to be brought up. So that means the first step for refining is to utilize fully the cokers of the world, the upgrading units, which is currently today not running full out in China and in the US particularly. So that's the first step. Cokers will have to run harder. And also we think there's going to have to be yield shifts, stealing from gasoline and move towards gas oil diesel. But that would require spreads to blow out between high and low sulfur products and heavy and light products, and also between diesel and gasoline, because otherwise you will not feed the vacuum gas oil into the hydrocracker, which is the diesel machine in the refinery. So these steps in the refining system will require more and more wide spreads between the different products, price-wise. Next step is for the refining system to segregate the streams better, because there's some giveaway on the sulfur levels. So that means they're going to build some new tanks, some new pipelines to segregate streams that today ends up in resid fuel, but instead could end up as being 0.5% fuel oil for the shipping industry. So these steps are going to be gradual, but they would require a wider and wider spreads from between the products, price-wise, in order for the refineries to take those steps. But even at the end of the day, when all these steps are taken, it will not solve the problem full out for for the high sulfur fuel oil, because when you run the system harder, you create even more of a problem for the high sulfur fuel oil, just like we saw in 2008. So in that effort to fix the diesel problem, you saw that the oversupply of high sulfur fuel oil became even worse. And that's how the spreads in 2008 between those two products was blowing out to more than $700 per ton. This is not priced into the market today. The spread between those products is pricing around 320-ish for a Sing 380 and about $15 more for Rotterdam 3.5% versus gas oil, for example. So this is not priced into the market today. The market is almost like it's pricing in a recession today, because that's the only way I could see the refining system not being pushed to the limits in 2020. Because if you think about it, we have 700,000 barrels per day, a layer of demand growth for diesel every year. Now, when you, on addition, on top of that, puts the IMO change, where you suddenly the global refining system will have to produce another 2 to 2.5 million barrels per day more diesel just from 19 to 20 for blending and for direct consumption, you have a big challenge for the refining system. So basically, for this not to be a challenge, we need a fairly large recession that chops off diesel demand growth in 2019 and 2020. And I would say that's almost like the market is pricing in today.
You know, two questions. One is, when you look at the forward curves for the high sulfur fuel oil and the gas oil, you've already talked a little bit about the mispricing. And so in your opinion, you know, how much is the market mispricing? And the second part of the question is, how much incremental further demand will the refineries have for oil at the beginning of the refinery process relative to where they are today? looking out to 2020?
Yeah, the forward curves first is pricing in about, I would say 13-14% IMO effect for high sulfur fuel oil, because that's the backwardation structure if you take out what's coming from the crude oil side, because all the refined products, they will have the same type of structure as the crude oil curve, because that's the most liquid curve. So if you extract that, you'll see that probably around, I would say 14% is priced in for high sulfur fuel oil. For gas oil, diesel, it's only about 4% that's priced in when you adjust for the crude curve. So this is, I would say, very, very conservative pricing at the moment in the forward curves. We think it's going to be much, much wider when we get to 2020. And if high sulfur fuel oil needs to compete with coal in power generation, it needs to drop in price by more than $250 per ton by 2020, because coal is pricing down at around $130 to $140 per ton in burning equivalent with resid fuel at the moment. So you have a margin of high sulfur fuel oil versus Brent, which, yes, it has been pricing in a bit, but it's going to be much worse, I think, when we get to 2020, because it probably needs to correlate with natural gas, and at the end of the day, probably also coal in 2020, if it's not enough to drop to natural gas price. But that's still lower than where the market is today for natural gas. Now, for the diesel side, as I said, it's only priced in about 4% IMO effect, which means also that when you look at the simple refinery forward curves today, you put in the different prices for calendar 2020, you can see that it's pricing in at around negative minus $150 per barrel. Normally, that simple margin should be about $0.50 to $1 for the very simple refining system that when you just look at distillation tower and the natural content of the crudes. So this basically means that if the forward market is correct today, we will see refinery death in 2020 for simple refineries. We don't think that could happen, because the market would need to see higher utilization rates for refining, which means we need help, probably also from simple refiners, to run harder to get enough diesel in 2020. That is, unless we have a recession first. And of course that could happen, but that's basically already priced into the market, in my opinion. And I think it would need to be a very severe recession in order to keep diesel demand growth negative, because diesel demand is growing all the time, and the only period we've seen it drop is the 2008 and 9 recession. So we need to see something similar to that in order to for the forward market to be correct in its pricing right now, in my opinion. So what was the other question again?
If the refineries have to work at this higher utilization, what is the incremental oil demand that they'll require?
Yeah, and that will depend on how much spare capacity there is in the upgrading units. Because if there's spare capacity in cracking and coking, for example, you don't need to run necessarily so much more crude oil, because then you'll just fill up, you'll buy straight run resid fuel from a refinery that doesn't have a cracker, and you feed your cracker with that as a feedstock. But we think into 2020, all these units will be fully utilized, which means that you'll have a gearing effect of 3 times the demand growth for diesel. So I think it'll all depend on a mix of factors, of course, and we could also risk that this situation squeezes the oil market to an extent similar to 2008, which could then by itself lead to a recession. But of course then that will not be a problem for positions that we're taking, because those are flexible financial contracts that you just exit when they blow out, we will have a home run in 2020 if the Brent price responds like in 2008 and the spreads are something similar to 2008.
And finally, tell us about the SPV that you're establishing, and tell us about Vistin Trading, please.
Yeah, so Vistin Trading is a fully owned subsidiary of a pharmaceutical company. It sounds very strange, but the reason is that our main shareholder already controlled this pharmaceutical company. So in order to get a quick start and to raise capital fast, he wanted to establish this trading company below that pharmaceutical company. So as of now, Vistin Trading is about 3/5 of the value of the whole company. We raised about 300 million NOK, which we have put a decent part of that to work already, placing bets on the IMO 2020. And we also want to offer a launch of fund-like structure, an SPV, where the participants will be able to utilize our knowledge about the oil derivatives market and how that's going to respond to the IMO 2020 change. Because if you want to have the cleanest possible exposure to this, you should go directly into the oil derivatives markets. That's going to be the cleanest exposure. It's not so clean to, for example, buy shares in complex refineries or buy shares in shipping companies that have bought scrubbers and have efficient ships, or maybe you want to buy a scrubber producer. All these kind of exposures are, yes, they are IMO 2020 exposures, but they're not clean. They're more like second and third round effects, because the first round effects will be coming in the oil derivatives markets. So we have identified about 10 trading positions that we would be executing on a sequence in this SPV, and for investors that want to participate in the most clean way to play the IMO 2020, it's possible to contact us to participate in this. So this is going to be a fund-like structure, a special purpose vehicle that will only live until the summer of 2021, because then if nothing has happened by the summer of 21, this is not going to happen, then these effects will not take place. So it's going to be enough to close it down in the summer of 21. Then all the investors will be handed back all the investments and the profits, which we think will be very large. All the risk reward in these positions that we have identified is very skewed to the upside.
Very good. Torbjørn, thank you very much.
No problem.
Well, this has been a very interesting discussion, and obviously it's on a topic that really makes the headlines in the industry on a daily basis. So thank you, Jim, for directing the discussion, and of course, thank you very, very much, Torbjørn, for your really invaluable insight. So we have now reached the end of our discussion, and I'd like to thank both Jim and Torbjørn, of course, for being with us today. This podcast is available on Capital Link's website at www.capitallinkpodcasts.com. Also, it is available on iTunes and Google Play. Now, Capital Link aims to bring you weekly podcasts on critical topics for the shipping industry, discussing with industry leaders and decision makers as we did today. So thank you to everybody for being with us.
Thank you.